So scarcity versus abundance. So what you do when you print more money means there's more money around. So it lowers the value of the money. So that's debasing currency. So this is why they can't let the system go bust, because now there's so much leverage. So scarcity versus abundance. So what you do when you print more money means there's more money around. So it lowers the value of the money. So that's debasing currency. So this is why they can't let the system go bust, because now there's so much leverage that everything goes. And we saw this in Argentina, famous moment in Argentina in 2001, I believe it was, called El Corralito, where the Argentinians couldn't pay their bills, the government. So what they did is they had this dual economy, the Argentinian peso and a dollar-based peso. They just took all the dollars from the bank accounts and convert them into pesos. So they got the dollars themselves to pay their debts, but basically utterly destroyed the peso and destroyed the economy. So much so that Argentina reverted to barter. It was an extraordinary moment in time. So that's the risk. The other time we saw something similar in a more developed country was Cyprus. Cyprus, a European country. Now, Cyprus, they had a financial crisis. There was too much debt. It was based around property. And so what happens is the banks were insolvent, like they were in the US and like they were in Europe. But the answer was the ECB said, we're not bailing you out. So what they did is took any deposit out of the banking system over 100,000 euros and took it. So it wasn't your money. This is what got me into crypto in the first place. Once I realized it's not your money. Even if it's in a bank, it's not your money. These are the laws of unintended consequences that happen if you allow the collateral to go under. If we were less levered, like in India, the country's very unlevered, 60% of GDP in debt, in a fast-growing economy, it's growing 10% a year. Right? That's like you taking the mortgage out and the mortgage isn't that big and you've got great income. Right? The probability of you not being able to pay that debt is very low. So it doesn't matter if Indian assets fall a lot and stuff like that, because there's nothing systemic there. You're not going to destroy the population. But when it's the US or Europe, you can't allow it. You just simply can't. Because also, part of this is you've got this huge old population of retired people or people trying to retire. If you allow the market to clear, then their savings pool disappears. Now, it's all right for you and I. We've all gone through parts of our career where we've lost a bunch of money and we make it back. You know, you've created a startup, doesn't work. You work hard, but you can't do that when you're 75 years old. Because their banking system didn't really function and they were more restrictive on their lending policies, which is a function of their economy being more emerging than developed. So people don't want to lend them as much either because they're more risky. You're like a startup, even though India is obviously a very old thing, but you know, in these terms. And they ran a bit more inflation than other countries. It's really that, and they have a culture of savings. It's because when you're able to borrow, because you're the richest dude in the street who earns the most money, which is the United States, and humans have a propensity to borrow to create the image of this future self. The future self was the amazing United States of America, that dream that we had in the 50s. That dream died decades ago. And to fund that dream, the mismatch between the dream and the reality is debt. Sometimes debt is not all bad, right? Sometimes it can help accelerate some of the things. But if you're doing it to fund a dream that's never going to exist, that's the danger. Economic growth, technology, peacetime, and abundance and opportunity for everybody. Everybody could be the president, everybody could be rich. That mentality is terrifying because it creates a misalignment of present self and future self. So everybody feels like they never got there. You know, this was the whole book, Fear and Loathing in Las Vegas by Hunter S. Thompson, was basically this. That's what Vegas is about. We don't have gambling in the same way in Europe. You can go and gamble. It's just not a big deal. But in America it is, because it's about this future expectation of yourself, I think, driven by the American dream. And obviously a frontier-style economy and how the US, gave birth to itself. So the American dream was set up and a whole construct was set around it. And then two bad things happen. Bad thing number one is everybody goes, this is fucking amazing. I want to have kids. Prosperity, great times. So all of the people who've gone through the war, or maybe two wars, had kids. Those kids were the baby boomers, and they had too many kids. So what happens is if two of us go for a job interview, we have a 50-50 chance. If 1,000 of you do, you have a 1 in 1,000 chance. So what happens is if too many people come into the workforce at the same time, they compete with each other for wages. And if you look back and inflation adjust wages for the average median American, or the average American, particularly the median American, over the last 45 years, it's not gone up at all. So there's been no productivity growth. The miracle never happened. But in the meantime, the price of assets went up. Why? Because there's a whole bunch of people at the same age who all want to buy a house at the same time, all want to buy into the stock market at the same time to stay for their retirement. They pushed up prices. And so the more they tried to buy over time, the more it went up. And they got this massive gap. And that gap between their earnings and the costs of assets that you secure your future income in kept going up. So they borrowed money. And when you basically adjust by asset prices like house prices versus wages, the difference is the debt. And then the government started doing the same. So it was all driven by the baby boomers, but the baby boomers had a second shock and a third shock. Second shock came really in the mid-80s, which was computers. Computers started competing for jobs with people, slowly at first, and then faster. And then 1996, 1999, 2000, well, 1996, the World Trade Organization, WTO, agreed that what a great idea. Let's all trade without tariffs with each other. Free markets. Yeah, well, the free market actually meant that when China entered the global workforce, they would work for a fraction of what you and I would work for. And so that meant labor costs never went up. And the cost of goods got cheaper because China could produce them cheaply. So we just gorged on this stuff because there's cheap goods. We borrowed more money because we had this future expectation of ourselves being rich, the American dream, and we gorged on more money, and we borrowed money to see if we can make money from asset prices. So this whole thing was driven by demographics, and that came out of World War II. So it was World War II that drove all of the mess we're in now, and that's the same globally. So they're all older populations. The US had the millennial population. So the millennial population, it pops up into the workforce. You know, the millennials, about 4 years ago started hitting 30 years old, that big thing. This is a big bunch of people. Problem is they look into the world, their parents are still in the workforce, so they need to compete with jobs with their parents. There's a whole bunch of them competing with each other. They all try and go to university to see if they can get a better job. So they drive up the cost of university. They then come out of university, they try and buy a house. They drive up the cost of house. I mean, it's just a mess. When you have these bulges of population, you create all these distortions. So these millennial population are pretty screwed because their parents have driven up the price of assets so high, trying to save enough to retire, which has never really happened. But they come out and say, right, I'm earning money now. What do I buy? Oh, the equity market at all-time high valuations, the bond market at all-time low yields, property prices are too high to afford. I'm fucked. Again, all of these are why I got to crypto, because I knew that I had a different expected future return because their parents hadn't owned the stuff. And therefore, they themselves could help drive the price up and the adoption as long as they bought it. Financial market terms or macro terms. I think there's three things you need to do here. One, income. Income rules the world. Income pays your bills. Income can pay your mortgage. Income does everything. Without income, you got nothing. Income takes hard work. It's hard to get up the ladder, earn more income. Secondly, is you need to have optionality. You need to have things that can pay off. A startup or a hobby business on the side can give you optionality because you can build a business and a business has intrinsic value, plus it can increase your income. That will never happen if you work for a corporation. Yes, you can have a great career and do fine, but you'll never have that extra upside that you and I have had by building businesses. So that is another thing, is focus on your income, work hard, look for other opportunities that can leverage that income and opportunity set that you've got for you. And then thirdly is, if I've got this income, look for investment opportunities that can change my life. And that doesn't mean being a degenerate gambler. It's like, simply put, if there is a thesis, for example, in cryptocurrency that you and I share, that this is a long-term network adoption of this incredible technology that is exponential in nature and highly volatile, you should be looking at the moments of extreme weakness, the blood on the streets moment, to be buying more, not on leverage. So if you'd have bought a house after the 2008 crisis, you'd have done very well.